The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you.
Welcome to the JMF Advisor Show. I am Dan Johnson. I am an auditor at JMF, and this is my counterpart here today.
Hi, I'm Lynn Osborn. Glad to be here.
And we are going to be talking to you about the topic of leases, topic 842, and the new lease standards.
It's a great topic, isn't it, Dan?
I don't know that I would say it's great. It's another change like RevRec, but here we are. It's upon us, and that whether you like it or not, you have to learn it.
That's exactly right. So the first question a lot of people ask is, why do we have to do this? Bigger picture is, there was a move for convergence toward IFRS. This is basically the result of that. Wouldn't you agree?
Yeah, it gets us closer to IFRS and US GAAP and the standards. They aren't exactly the same, but this makes the standards much closer on how operating leases and capital, which are now called financing leases, will
That's
be
going to be
treated.
hard to remember that, right?
Correct. The biggest change, though, is how operating leases will be accounted for. And the theory behind it is that we wanted to show the assets and liabilities related to operating leases on the balance sheet. And that's the biggest change. Prior to this, you could have off-balance sheet reporting where you just reported essentially the cash paid and the lease expense, and you might have some prepaid rent and accrued rent. And that was really it for operating leases. The biggest change that we have is those are now required to be recorded on the balance sheet.
That's correct. So all of those debits that we would normally be posting to the income statement, they're going to come back to the balance sheet and they're going to become a right of use asset, correct?
Correct. And we have a lease liability. Do you want to go into that part, or do you want to go into leases how we record leases?
Maybe we should just talk about who this is going to actually apply to. Some of the first questions that a client's going to say is, wait, that's got to be for a public company. I'm just a small private entity. This doesn't apply to me. Or I just have this small operating lease that doesn't apply to me. Or maybe I just have a related party lease that doesn't apply to me.
Unfortunately, there is no separate gap on this one. This one is everybody follows the same gap. What Microsoft has to do and what Amazon has to do. Yes, you shop in Tuscaloosa have to also follow that.
Absolutely. And what about the length of the leases? Who can actually get out of this?
So the way they define the lease is it's a contract that conveys the right to use an asset for a period of time with exchange and consideration. And that's the basic definition. The asset is required to be an identifiable asset. So it has to be a specifically identifiable
So we're talking about property, real estate, a vehicle. Think about that forklift that you leased.
Correct.
Those
now,
items.
There is a right of substitution. If they can substitute that asset out, it cannot qualify. So an example might be if you have a coffee maker from Buffalo Rock, and Buffalo Rock, if that one broke and they could just drop another one in and swap it out, It's not really a long-term lease. Then we're not talking about a lease that's not an identifiable asset. It's easily swapped out.
Gotcha. I'm going to say the first question that some of our clients are going to say is, what about our copiers? They're not super expensive. What do we have to do with those? Unfortunately, there's not really a materiality threshold unless we're getting into your capitalization policy. And it's something that's clearly insignificant. You can ignore these rules, but most of them, if it's going to be over your capitalization policy, it's going to be a debit that comes to your balance sheet, right?
Correct. And most of those, that will be the case. Now, the lease term is something else you asked about. The lease term is if you had a copier and it was less than 12 months, sure, you don't have to count it as a lease. The lease terms are greater than 12 months. But that's somewhat deceptive in how they've defined it. It's the non-cancelable period that you have, but that can also include extensions if you're reasonably certain that you're going to extend the life of the lease.
Right. If I've got a 12-month lease, but then I've got options to renew for the next 4 years, what happens then?
You have to assess, and this is really a management's judgment, whether it's reasonably certain. Reasonably certain is defined roughly as about 90%. So if you're 90% certain you're going to renew this, then yes, it counts as a long-term lease. And those periods which you're reasonably certain to exercise that extension, those get included in it. So a lot of times you have buildings and you might be in the third year of the lease and it's a 5-year lease and it has 5 years to extend and maybe another 5 years to extend. At year 3, you probably will know whether you're extending for another
Right.
5 years. You might not know that you're going to extend for 10 years, but it's
But for
probably
5.
reasonably certain for that
Yeah.
5. And then you go, well, now my lease term is not 2 more years left. It's 8 more years or 7 more years left, right?
What about my month-to-month leases?
If you have a related party that is truly a month-to-month lease, then yes, you can. They are exempt from the lease rules. So the
What if it's
month-to-month,
not a related party? If it's just a regular month-to-month, I think that you
regular
can
month-to-month, any
also be.
month-to-month.
Yeah.
So with the related party, you have the opportunity to rewrite your leases to make them month-to-month. If it's truly related party and everybody involved is fine with changing the lease to be month-to-month, you can do that to avoid these rules.
That
But
sounds good.
if you do have a month-to-month, then it is not long-term. They are not subject to these new lease rules. It's literally a period cost. It's a rent expense in the period it occurred.
Just wrapping up the related party, those kind of leases can be rewritten so that you can maybe get out of these rules. But if you've got a related party lease, you can't automatically say, wait, this new lease rule under ASC 842 does not apply to me because it's a related party. Maybe it's an LLC that owns the assets separately from the company. Those are still related party leases if it's a non-cancelable agreement over a year.
Yeah, if it's over a year and that's the terms of the written lease, that's the terms of it.
Let's back up 1 second and talk about the capital leases, because a lot of people will start thinking, wait, the new rules under 842 just replaced the 840. And maybe these new operating leases are going to get popped into the old schedule where we're actually calculating capital leases. Because we've got a lot of clients that do have staff on hand that calculate this kind of information. Let's talk through, if we were talking to their controller, their CPA on staff, let's try to explain the differences between really, truly a right of use asset that's going to go on your balance sheet as opposed to a capital lease item. Those things are still going to remain separate on your financial statement, and that right of use is not going to be popped on your depreciation schedule.
Yeah, and that's correct. The capital leases are changing only very slightly. They are now defined as financing leases, not capital leases. But the old 4 criteria that we had, that this was, 90% of the present value of minimum lease payments, and that it was 75% of the asset life and the bargain purchase option and the transfer. All of those are still there as the criteria. They just took out the bright lines. Instead of it saying 90%, it's substantially all. What's substantially all defined as? Well, if you and your company want to define substantially all as 90%, you can do that.
You can do that.
And if you go the major part of the life of the asset, if you want to define it as 75 as your policy, you can do that. So it really didn't change those two. They did add one that says if this asset is unique and doesn't really have any other use outside of for you, the customer that's leasing it, then that also makes it a capital lease. So they did add a 5th rule that if the piece of machinery you're getting is so unique to your business that it is just not usable anywhere else, that also becomes a capital lease.
Gotcha.
The other major difference is that how do you calculate the capital lease asset?
Okay.
And the theory behind this was they wanted you to add in the indirect cost. And the indirect costs are costs that you incurred in order to acquire the leased asset. And the idea is if you were to acquire this and buy it as a fixed asset, you would capitalize.
Absolutely. Any kind of installation costs, delivery costs, sales tax, all of those costs, you'd wrap up those and put them into depreciation.
Correct. And so you need to now add those into the fixed asset value when you make your capital lease, but you're still going to account for these essentially the same way that you did under 840 as an 842. You capitalize the asset, you put it onto your fixed asset schedule, you depreciate it, and for most people, that's going to be straight line, how they do their depreciation. And then you're going to reduce the liability in accordance with the amortization schedule, that there's going to be a principal and interest portion of the payment. The other difference with the new 842 is there's some enhanced disclosures that you have to explain what the financing lease cost is, which we kind of already do this in that we've already disclosed here's the depreciation or amortization on those assets, but now we're required to go, here's the interest that occurred in that year. And you're supposed to show the financing lease cost every year for the amount of interest paid on the capital leases and the amortization together to get to the total financing lease cost. That's a little bit additional disclosures, but it's not really anything different than what we've been doing before.
Gotcha. So it's two-pronged though with implementation. We've got measurement aspects and then we have disclosure aspects, correct?
Correct.
So let's talk about like, who does this actually impact? So anyone that has a financial statement, that is a financial statement user that has a preparation, a compilation, a reviewed financial statement, or an audit, this is going to be applicable to that group of people. Now, if we just have a tax return and we're not filing any kind of financial statement, do I need to worry about that as a client? If I'm just a regular business filing a tax return?
If you have disclosures, there will be additional things, even if you're not on GAAP basis.
Correct.
Just as when we had tax basis financial statements under 840, you had to make disclosures for capital leases. Those disclosure requirements don't go away, whether you're tax or other bases of accounting. You still will have some of those disclosure requirements. They just won't be capitalized on your balance sheet. There is one other major change, though, is we didn't go over the operating lease, but I want to go over some of the debits and credits of the operating lease too.
Oh, we love some debits and credits.
The operating lease goes a little bit different now. So like normally the liability side of the operating lease is actually going to be exactly the same as a capital lease and how it gets initially recorded. So the measurement recording it's going to be the fair market value of minimum lease payments.
Okay.
And it's the future payments. So if you had a prepaid rent or you paid something at the front end, those don't get factored in. This is only the future payments that you have. And that's the same for both the capital and operating lease side. The difference comes into is how do you value the right of use asset and how do you treat those subsequently when they get moved out? But actually recording the right of use asset for both operating leases and capital leases is exactly the same. And let me pull this definition up so I can get the exact definition. Yeah. The right of use asset is recorded at the lease liability plus any prepaid lease payments minus any lease incentives if the lessor gave you any lease incentives plus any of the indirect costs. So the initial recording of the asset is the same for both operating and capital lease. Where it changes is how do you unwind those two assets and liabilities?
How do you start recognizing them over the periods?
Correct. So for capital leases, you do it the same way in 840 and 842 with the amortization and interest. The interesting thing for the operating leases is they wanted to preserve the old treatment of when we had cash and lease expense. The cash went, out. You had the lease expense. You recorded it. You may have had a prepaid rent or accrued rent liability. They want to keep that presentation. So you end up taking the total lease payments of the entire lease plus the indirect cost. That amortized over the life of lease is your expense. The lease liability is reduced based upon the amortization table. The cash you paid out is the cash you paid out on a monthly basis. The plug is the amortization of the right of use asset. There is a bunch of math behind it, and you could calculate all those numbers and we could explain how that amortization works. Right. But the simple answer is the plug in here is the right of use asset amortization. We know what the lease liability amortization is based on the lease amortization schedule. We know what the expense is based upon the straight line expense of the total expenses over the lease payment. We know what cash they're required to pay in accordance with the agreement. You end up plugging the amortization to the right of use asset. And that asset does not go on your fixed asset schedule.
Correct.
It is
It's
a
going to be,
separate
we're going to
asset.
amortize that completely separately, right? Now,
Correct.
this calculation that you're talking about, this can get a little bit more complex if you've got more complex leases, correct? Like if we've got escalating leases, if you've got a complicated discount rate that's got to be calculated, it can get really complicated.
It can get very complicated because there's other factors that go into it, like prepaying rent will change the terms. You'll have, because now it's not, the cash you're paying out is not going to be equal to the expense. Escalating terms causes the cash paid out to not equal the expense. There's a lot of other factors that can go into it. The same with lease incentives. If they gave you lease incentives, that can also change how this gets allocated. And when you have those, you will end up with, let's put it this way. On a normal lease, if I'm renting a simple copier and the copier is $500 a month, and I'm just going to pay $500 a month, there's no escalating terms. There's no prepayments. There's no options
Just
or
your
anything on it.
plain
Straight
vanilla.
vanilla.
Okay.
The right of use asset and the lease liability will be amortized at the same amount throughout the entire time. So as the lease liability goes down, the right of use asset will go down at the same amount. The cash paid will always be equal to the lease expense.
So just for our average client that maybe just uses a bookkeeper at their place of business, what it sounds like you're explaining is that it works just like a capital lease. It's basically taking the debits and credits and moving them from your income statement back to the balance sheet, inflating it. But in the end, if I'm the owner, I'm worried about what is this going to do to my net income.
Yeah.
Explain that to me.
The balance sheet, whether it's operating or capital, will look very similar.
Correct.
The only difference is you have the option when it's a capital lease to show the capital lease asset separate from your fixed asset on the front of the balance sheet, or you can disclose that separately in the back of the footnotes. The main difference is how the operating expense shows up. Obviously, with capital lease, we have amortization or depreciation and interest, whereas the operating leases, we still have lease expense.
Right.
So it makes this slightly different in that. I don't know that I'm answering your question exactly.
No, I think you are. I think
Okay.
you are. But if I'm the owner, I'm worried about like
and-
my bottom line. To be honest, I just don't think it's going to change your actual net income that much.
It should not change your net income that much.
Right.
The only way it would change your net income is if you weren't truly accounting for the leases correctly on 840.
We don't have any clients that
And there
don't
are some people
calculate
that it's just not material to calculate the escalating lease terms correctly, and that they probably passed on it. But for the most part, it should not change a thing on your income statement. But it will affect other things, like if you have debt covenant ratios,
Right.
is if your banker has not addressed these changes, your assets and liabilities will be grossed up.
They will be.
One of the other areas that this will also change is contractors' reports. Is if your contractors' reports are required to be on GAAP basis, they don't allow them to be income tax basis. So if you just have done a compiled balance sheet in the past with no other disclosures, no income statement, your accountants may not have looked at operating leases, and you may not have looked at operating leases because those were never required to be on the balance sheet.
Absolutely. They could be totally under the radar and you just don't even know about it.
Correct. And that you probably need to reconsider leases, and do they need to be on that for your contractors' reports, as well as your LDOT financial statements too.
Correct.
They'll have to go on there. So you might have to look through those. Now with the LDOT statements, those were required to be reviewed. So I think that you probably should have already addressed that, but it still is something that you need to look out for.
All right, Dan, let's talk about when do these rules go in place? And if this is the first time you're hearing about leases or topic 842, all is not lost, but the time has really been upon us for a little minute, right?
Yeah. So for our statements that end at 12/31/2022, they are applicable. And then any period in between that will end. So pretty much if your year began with the 2022,
Yes.
whether it was January 1, 2022, or April 1, or June 1, or 10/1, you have these statements are applicable for that year.
So that means if I'm a client and I have any of those types of financial statements that we covered earlier, which is, a preparation, a compilation, a reviewed financial statement, or an audit, or if any of those those levels of service, whether your GAAP or your income tax basis, it's going to apply to me as of 1/1/22, correct? So now the panic sets in and you go, wait, I've been going all year and I haven't analyzed these. I haven't, booked anything. I haven't grossed up my balance sheet. How do I implement this? What are the options for actually implementing them under the different methods that are available?
Yeah, well, there's good news. If you're a JMF client, we have already actually begun this process for the prior year's leases. Because we do your work, we have your 2021 numbers, and we have partnered with Alliant Group to help us in doing lease conversions. And we can actually do those lease conversions for any client that needs it on your 2021 numbers so that we could get the starting balances for 2022. And then
those opening balances.
Those opening balances on January 1, 2021. Or if you want to do, which we'll get to that, you can go a full retrospective method and go back. But
nobody really wants to do that.
No one wants to do that.
No, we want to go ahead and record the opening entries as of 1/1/22, apply 842 to this year end, basically have the prior year information be under 840 and not change that. That's what most clients really want to do, right?
That's correct.
Well, it's easier also.
It is. But if you haven't even started this, come see us. We're happy to help out, and we absolutely can help you with those
we've got some good
conversions.
friends at Alliant Group that's helping us make those opening entries, coming up with those calculations, assisting with some of the information that's going to be gathered that will go into the disclosures in the back of the financial statement, et cetera.
Correct. And as Lynn said, most people have not, and even if you go to the SEC companies that have had to file this for several years now, almost none of them have opted to do a full retrospective approach and go back to the first year that they're presenting.
Nobody wants to restate.
So no one wants to represent last year or 2 years ago if you're showing 3 years. No one wants to do that. You do have the option of just going, we're adopting this for 2022, and that you're going to show the new presentation for 2022, and you can leave your old presentation for 2021 as is. And that's how most people are going with this. And that's how we at JMF are recommending people do it as well, because that is really just less work for everybody.
Gotcha. All right. Well, let's talk about the impacts of these. Or do you have any other topics?
Yeah. So the impact of these, in theory, there really shouldn't be any changes to equity when you adopt this.
That's right. No prior period adjustments.
Yeah. For most leases, unless they're very complex terms, the asset that you're going to put on January 1, 2022, and the liability that you'd put on your books are going to equal. And there's not going to be a significant difference. And if they don't equal, you probably should have had a prepaid rent or an accrued liability on the books, and then that gets collapsed into those so that they do end up making it equal. And for probably 90 to 95% of leases, there will be no impact to retained earnings.
Well, Dan, before we wrap up here at the end and talk about some other options and some maybe looking back, looking forward, planning things, let's get into the nitty-gritty about some of the actual definitions.
Yeah, one of the reasons why I want to cover this too is the lease payments. When we said, hey, for the most part, this is not going to affect your equity. This is one of these areas that could affect it and that could change it. And I wanted to talk about the lease payment terms. The lease payment terms, when you define what minimum lease payments are, we always just kind of said, okay, if it's whatever the payments in terms with the agreement that are fixed, but there is some other additional information that they've provided to us on here. And the lease payment terms can include variable payments And those variable payments can be if it's an annualized increase. So if your terms of your lease said, hey, we have the right to increase the leases by, 3 to
Whatever.
5% when we want, that's not really fixed. But if it says each year the lease payments go up by 3%, we can calculate that at the start of the lease.
Okay.
So it has to be fixed in nature, and those payments going up is those can change the lease payment terms, and having those escalating terms does affect how we do the conversion. And if when you were under 840, you were ignoring those and you were just going, look, it's not material, that will cause an adjustment to your retained earnings. There are a few other things in the lease payments that you do need to consider that are different from 840 to 842. That again, it's those, if I'm reasonably certain I'm going to exercise the option to extend, or if I'm reasonably certain I'm going to exercise an option to purchase it. It doesn't have to be the bargain purchase. It could be fair market value purchase. If I know I'm going to do that, that changes the terms of the lease, and that you probably need to look at some of your older leases and reconsider those, because those could change how this gets valued. The other one is sometimes there's termination agreements, and if you're reasonably certain you're going to terminate that lease, that also changes the lease terms. And so you do have to look at some of these things in here that we didn't used to look at, because you just go, look, if they exercise the option, that's when we address it. Now,
Correct.
Under 842, you have to make that judgment that if you're reasonably certain an option to extend, an option to purchase, an option to terminate, those need to be reconsidered, as well as variable payments that are fixed in nature, i.e. tied to an index or a straight percentage increase.
It sounds like you just got really, really complex all of a sudden.
It did. And that's where this can get very hard to go, hey, and some of it was you probably just need to go through those leases where you had options and look at those terms and go, do we have to reassess this for these new options?
Have you seen any of our clients reassess their situation, cancel leases, try to maybe set leases that they're beginning to sign now, structure them in different ways because of these rules under 842?
To the extent that they have the ability to do that, I absolutely have had clients that have chose to restructure leases to be more favorable in the terms so that they don't have to. I mean, it's fairly easy if you
Possibly less complex, maybe month to month.
Correct.
Definitely less than a year. Those are all good things that could be on your side if you plan ahead.
And it is easier if you're like the owner and I own 100% of the operations and I own 100% of my building, and I can change the rent and the terms of the building and that to be month to month. That is an excellent way to do that, but not everybody has that ability to negotiate a change in terms.
Right. Have you seen any of these leases upon implementation that had, material impact on the beginning balances? They've had any material impact on, retained earnings when you've done the calculation for them?
I have not. And in theory, you probably shouldn't see any ones that had material impact, because in theory, if it was material, they probably were doing it wrong under 840.
Right. Well, let's talk about the people that, because this has been a hot topic, of course, for several years. This ASU came out in 2015, 2016, somewhere around there. I think it was ASU 2016-02. So getting it implemented, it got kicked, way down the road. They kicked the can for a long time, gave us a lot more wiggle room than the private sector got a little bit more wiggle room for implementation, but we still have some clients out there that do not want to change the way that they're already accounting for their leases. What do we do with these people? Do they have options? We've done a lot of research. I think that those clients in particular that are not interested in implementing this, they really need to come and see us pretty soon. Wouldn't you agree?
Yeah, and the other thing that they need to assess is who's the user of their financial statements.
You got banks,
government regulators, owners. And the question is, can you choose one of these options?
Yes.
And at this point, not all of the options are known because not all regulators have told us what they're going to do.
Correct.
Not all the banks have made decisions.
Correct.
And so it is a difficult decision. There are ways to get out of this by going cash basis or tax basis, and that you don't have to capitalize these.
Right.
There is possible options of having GAAP exceptions, but these are all terms that you have to discuss with who the user of your financial statement is.
Right. So if I'm a client and I've got financial statements that are going to one bank or 10 banks, and I don't want to adopt these standards, and I'm going to have, a GAAP departure, possibly a material GAAP departure for not implementing them, I've got to discuss it early on with those users of my financial statements to make sure that they're going to accept it.
Yeah.
Correct.
And we do have, we have seen clients that, they're not going to adopt it, and the bank is fine with that. And
right.
and
Yeah. If you're a one owner with a one loan, it's pretty easy. Now, if
Yeah.
you've got multiple banks, multiple owners, getting everybody on the same page might be a little bit more difficult. There are options. If you say you're a client and you've got just a few leases, nothing material, but say I've leased a fleet of vehicles, but altogether we did the calculation and it's not a material adjustment. Can you pass on that if it's under a certain materiality threshold?
again, there is no materiality set for 842 that says, like repairs and maintenance tax law, that says, okay, if you have an applicable financial statement, anything under $2,500 you can expense if you
Right.
adopt the safe harbor. There's no such thing for
Correct.
GAAP on this one. And what it really depends is what's material to your financial statements and what's material to the users of your financial statements, which is why you really need to go back to who your users are and answer that question. And it may
Correct.
be possible that you could pass on it, or it may be possible that you just give the exception. Like, is another example, Germany did not adopt the IFRS new rules, and they don't want to adopt the US GAAP. And there's lots of suppliers here in town that are part
That
of
are not.
Mercedes
Mhm.
that do not want to adopt these new lease rules. And I've had clients that have talked to their bank, and their bank says, yeah, they don't care, because the purpose of the financial statements at the local, Tuscaloosa County
Mhm.
supplier gets wrapped up into the whole consolidated one back in Germany, and they want it to stay on a lease that's
Consistent.
consistent with
Mhm.
theirs, so they
Mhm.
don't want to adopt it. And we've had those conversations, and our clients have with the bank, and they've said that's fine and that we're not going to adopt it. But that is, again, you have to go back and talk to that banker.
Right. And most of our clients really need to have these conversations really, really, really soon. Additionally, if you've got several leases, we need to take a peek at them, run some calculations, see what the financial statement impact is. See if we can possibly do a past adjustment. If we can't, we've really got to talk about like how it's going to modify the report. That's one thing that we haven't really spoken a lot about. We've talked about a GAAP departure, but really that means that you're going to go from an unqualified opinion to a qualified opinion. If you don't take the time to sit down and actually calculate it and pass on it, if you just, me as a client, I say, my owners don't care, the bank doesn't care, no one wants to implement this, and I do not want to take the time to calculate it. What does that mean for me? What can you as an independent CPA still perform for me? And the answer is that we would have to qualify their opinion on that audit or that review engagement.
Yeah, and that is correct.
Yeah.
And that's where we're left, is it's really up to who wants those financial statements.
The user of the financial
There
statement.
is, though, that we did mention earlier too, though, even if you go to those OCBOAs or tax, there are still disclosure requirements that you still don't get out of.
So what you're saying is there's really no escape.
There's
if
not
you're
really an
any kind of
escape
financial
completely
statement
from
client.
this.
Yeah.
Unless you're issuing like non-disclosure financial. There's really no escape from this. You're going to have to deal with it one way or another. You can't just go, we don't want to do it and we don't want to pretend it exists.
Mm-hmm.
It's going to affect your financial statements one way or another. Well, I really appreciated this time here, Lynn, talking to you.
Absolutely.
And
Appreciate
you
your time
all
as
can
well.
You all can follow us on YouTube or any of your favorite podcasts and pick up the other great JMF advisory show.
Or contact
topics.
us directly.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.